Good afternoon, Gary. Thanks for joining us again. How are you?
Good, thanks, Leah. Uh, Considering this isolation, perhaps not so bad as I thought it might be. How are you?
I'm all right, thank you. Yeah, plenty to do. Not twiddling my thumbs at all.
Good,
It's
good.
nice to catch up with you, and here we go again. Uh, I thought we could have a quick look at the markets.
Sure, sure. Um, Markets are following a path that we said they would, which is some very, very strong days and some very weak days. Today is not such a great day. Markets off about 3.5% on the futures markets this morning. But that comes on the back of some better days. Last week was a really good week. So what's unusual is we are seeing huge swings on a daily basis in prices, and that's something which we think will continue for some time. And in a way, it's not dissimilar to what we saw from October 2008 through to March 2009. Once the market got over the initial fall off from the bust of Lehman's in 2008, 2009 global financial crisis, then it began to gradually pick up and get better. And I think you'll see something similar here, except the difference with this time round, because it's based on an external threat, i.e. the COVID-19 illness, a pandemic, that it's escalating and accelerating the effects through markets.
Sure. So, is there any evidence, I suppose, looking back as you analyse historical data quite often, how the economies will react and then subsequently respond? Can we look way beyond now?
We can do. Now, I'm going to preempt what I'm about to say by just warning everybody that economists have an absolutely lousy track record on predicting where the economy is going. And all the good economists will tell you that. So what I think it's important for people to understand is that you get real surprises that nobody really foresees. And if you think about the slow way in which the economy has recovered, sort of post the 2008-2009 global financial crisis. We've had around 12 years of economic growth, but it's been a very slow rate considering how badly affected the economy was in 2008-2009. Now, history never repeats, as they say, but it does echo. But if you track back to sort of 1929, when a major financial crisis triggered a global depression and hit economies really hard, they didn't do so well in the early 30s. And ironically, what seemed to reset the global economy was World War II, which in its effect was quite Keynesian. Countries went to war, blew things up, then had to rebuild them. What nobody would have forecast, however, in 1945, was the remarkable recovery of the German economy subsequently, which has been one of the strongest economies in the world through the second half of the last century and continuing today. What they called the Wirtschaftswunder, which was the miracle of the Rhine, the rebuilding. Now, you could get something similar now, because as people that follow the Courtiers information will know, one of the points I've been making is that this country has seen no real increase in productivity for 10 years. So productivity improvements are flat. And if you want to increase people's standards of living, you have to drive up the productivity of the population. In other words, we have to get more output for each person that we've got in our economy.
Sure.
And it could be that the effect of something like COVID-19 is to have a resetting where companies find more efficient ways of doing things, employ different tools, and we have the economy coming out the other side quite strongly. Now, I'm not going to say that's my firm prediction. I'm going to take a route of what most economists or financial analysts like me would do, which is perhaps give you three possible alternatives coming out the other side. And I'd say the three of these. One, we are going to get a massive recession. Everyone needs to be sure of that. You're going to see some shocking figures through Q1 2020 and Q2 2020. It's going to hammer the economy. It could be down 10% quarter on quarter, one of the worst quarterly recessions that we've ever had in history. Q2 is going to be quite bad as well because things are not going to recover. Here we are, 1st of April, and the country's still in lockdown, as are lots of other economies throughout the world. So that's going to be bad. The question then comes is, when will the lockdown come to an end and how will the economy respond? So 3 alternatives here then. One, that there's an almighty hit to GDP in Q1 and Q2, and we'd never recover it, and the economy
Sorry, Gary, we just lost,
and perhaps even...
We just lost you there, sorry. There's going to be... Can you repeat that? There'll be a massive hit?
Yeah, there'll be a massive hit to GDP, to output in Q1 2020 and Q2 2020.
Sure, thank you.
And the question is, in Q3 this year, will it start to recover? Will we get back this lost economic output? Or will the economy just shift downwards at a lower level and then build gradually from there? So worst scenario, that Q1, Q2, GDP, enormous recession, that's going to come anyway. I mean, you haven't got to be particularly clever or even qualified in economics to understand that that GDP in this country has taken a hit for the first half of 2020. Just look at the number of closed restaurants, reduced amount of transport, etc. Do we get that back quite quickly? In other words, does it come steaming back in Q3? Or do we have a slow recovery where there's no bounce back? So worst scenario, no bounce back in Q3. We simply get a loss of output for the first 2 quarters of this year, and then the economy follows, resets the same old trajectory, and the economy's lower forever. More modest scenario, there is a strong bounce back in Q3. I think that's likely because I do think the population will want to go about doing things, buying things, shopping, doing things socially, going to the cinema, going to restaurants, going to pubs. So I think you will get, this is the more likely scenario, a bounce back. And I think then there's a possibility you'll get a bounce back and we'll resume on a path. In other words, there's no one-off massive hit to GDP. We just get back a lot of what we've lost and we resume a new path. But the third option, which is interesting, is that the economy actually resets, like the German economy did post the late 1940s. And having gone through this stress of a major pandemic, something we're not used to, we find improved ways of working, we find better uses of our capital, and companies start to invest for a brighter future because we all feel more optimistic. That could come on the back of a government that's throwing the stimulus into the economy. And then what you could see is a boom, which we haven't seen for many years. So my prediction, I'd rule out number one. I don't think it's going to be Armageddon for the economy. I think 2 or 3 are the 2 most likely scenarios. And just for anybody out there that says I'm always an optimist, that's because I've got history on my side as an optimist, because things tend to improve. And I don't think in the end this will be any different.
Thanks, Gary. Thanks. And just quickly then, what are we doing to manage the financial resilience and the liquidity of the Courtiers funds through this?
So one very important thing with any crisis, how you go into it is going to determine how you come out the other side. So any funds that went into this crisis holding a stack of illiquid stock are going to struggle. They're not going to be able to come through this well. It's going to be difficult. And recently you've seen property funds get shut down. So open-ended property funds, sort of old property unit trusts, have had to close down because they can't value their assets. Now, we haven't held those for 14 years. We stopped holding open-ended property funds in 2006, and we've never gone back. And anybody who wants to find out why, ask Caroline to send through one of her research notes on that subject. It's well documented. So you don't want to hit a crisis like this with illiquidity in your funds, and we didn't. We were holding lots of T-bills. We were holding very, very liquid positions, and generally we've had no problems trading. We've not had to put any restraints on liquidations of any assets, and we've priced as normal. And that's exactly what happened when we went through the 2008-2009 crisis. As investors with us will know, we are always mindful. Number one, risk. Number two, liquidity. You've got to take those seriously. But if you are not in good shape when you hit a problem like COVID-19, you won't come out the other side particularly well. So far for us, it's been fine.
Thanks, Gary. Thanks for that insight. It's good to see you again, and I look forward to seeing you again soon.
And you, Leo. Thanks for the chat.
All right,
Take
thanks,
care.
Gary. And you. Talk soon.